Hello everyone, I'm Miles. Today we'll use a practical example to learn by solving and see how to turn a company's free cash flow, also known as unlevered free cash flow, UFCF, into equity free cash flow. That is, levered free cash flow, LFCF. We'll make it clear and emphasize how interest serves as the bridge between UFCF and LFCF. Core definition. UFCF is the cash generated by a company before debt payments, belonging to all capital providers. LFCF is the cash left for shareholders after paying interest and mandatory principal repayments. Now, let's solve the problem. Here are the problem's data. A company's EBIT is 10 million. The tax rate is 25%. Depreciation and amortization is 2 million, and capital expenditure, CAPEX, is 1.5 million. Change in operating working capital, change of OWC, is 0.5 million. Net profit is 6 million, and debt repayment is 2 million. Step 1. Calculate the interest. Net profit is EBIT minus interest, times 1 minus the tax rate. So, 10 minus I equals 8, meaning interest I is 2 million. It's crucial to work out the interest by back-calculating from EBIT and net profit. Step 2. Calculate UFCF and LFCF. Remember the standard formula. UFCF equals EBIT chanks, 1 minus the tax rate, plus D and AMP. A minus CAPEX, minus DOWC. UFCF equals 10 times 0.75, plus 2, minus 1.5 minus 0.5, equaling 7.5 million. LFCF equals net profit plus D and AMP. A minus CAPEX, minus DOWC, and minus debt repayment. LFCF is 6 plus 2, minus 1.5, minus 0.5, minus 2, equaling 4 million. As the CFO, would you distribute dividends? Step 3, the bridge equation. UFCF minus interest changes, times 1 minus the tax rate, minus debt repayment equals LFCF. Let's plug in the numbers to check. UFCF minus interest changes, times 1 minus the tax rate, minus debt repayment equals 7.5 minus 1.5 minus 2, which equals 4 million, which is equal to LFCF. In other words, after-tax interest plus debt principal repayment turns the cash available to all capital providers, UFCF, into the cash that ultimately flows to shareholders, LFCF. Interest is the bridge between the two. The key point is that UFCF shows the company's operational strength, while LFCF reflects the actual income received by shareholders. Understanding how interest moves between the two is crucial for translating the truth at the company level into the reality for shareholders. In modern finance and investment banking practice, cash flow is the language of value.